Home prices are falling in cities you were told were untouchable. But the cost of owning a home is rising faster than ever. That is the trap. Across parts of California, homeowners are watching their equity shrink while insurance premiums spike, taxes stay frozen at peak levels, and monthly carrying costs quietly suffocate household budgets. Buyers think they are finally getting a deal. Sellers think the worst is over. Both are wrong. Because this is not a story about cheaper homes. It is a story about ownership becoming financially unstable. So here's the question you need to answer before it answers you. Which cities are quietly making people poorer the moment prices start to fall? To understand what is happening inside these cities, you first have to understand why this housing slowdown does not behave like previous cycles. In earlier downturns, falling prices were often a relief. Lower prices meant lower payments, renewed demand, and eventually stabilization. This time, prices are falling while the foundations that once supported demand are eroding at the same time. The first shift was interest rates. From 2020 to 2022, cheap money disguised risk. Buyers stretched, investors overleveraged, and builders assumed demand would remain endless. When rates reversed, affordability collapsed overnight. But instead of prices instantly adjusting to match incomes, markets froze. Listings piled up. Transactions slowed. Sellers resisted reality. The second shift was migration. During the pandemic, California lost residents to cheaper states, but many secondary and satellite cities briefly benefited. That trend has now reversed. Remote work is no longer universal. Hybrid schedules are shrinking acceptable commute zones. Cities built on the assumption that people will keep moving outward are discovering that demand was temporary. Then came the structural pressure most buyers never modeled: ownership costs. Insurance premiums surged as wildfire, flood, coastal wind, and heat risk were reassessed. Some homeowners were repriced, others were dropped entirely. Property taxes did not fall with home values. HOA fees increased to cover rising maintenance and insurance. Utilities rose as water scarcity and infrastructure stress intensified. This created a dangerous imbalance. Even when prices decline, the monthly cost of owning does not. In many cases, it rises. At the same time, investors, especially small landlords and short-term rental owners, are exiting. Oversupply is no longer theoretical. It is visible in extended days on market, repeated price cuts, and rentals sitting vacant at reduced rates. This is why the current correction feels heavier. The usual recovery levers are missing. There is no easy credit. There is no explosive job growth waiting to absorb excess supply. And there is no guarantee that lower prices restore demand when ownership itself feels risky. If you want to understand where this pressure is most intense and why it matters before it spreads, stay with these 7 case studies. And if you want to keep tracking where the next fault lines appear, like the video, subscribe to the channel and turn on notifications so you do not miss what comes next. Because the warning signs are already visible, if you know where to look. 1. San Francisco. For decades, San Francisco represented the ultimate real estate certainty. Limited land, endless demand, global capital. If you owned property here, you were told you were insulated from cycles. That belief is now unraveling. At the peak of the market in 2021, the median home price in San Francisco pushed past $1.6 million. By 2025, that figure has fallen to just over $950,000, a decline approaching 40%. In the condo market, the damage is even deeper. Downtown and Soma units are down more than 50% in some buildings, with prices falling below levels seen a decade ago. But price declines are only the surface symptom. The real fracture came from employment. Between 2023 and 2024, tens of thousands of tech workers were laid off as companies reversed pandemic-era expansion. Office vacancies surged, reaching levels above 30% in parts of the city. Entire commercial corridors went quiet. Retail followed. Demand for urban living collapsed with it. At the same time, ownership costs refused to adjust. HOA fees in newer high-rise buildings routinely exceed $1,000 per month. Property taxes remain anchored to peak-era assessments. Insurance premiums rose as insurers reclassified earthquake, landslide, and hillside risk zones. For many owners, monthly costs barely moved even as their equity evaporated. The result is paralysis. Listings sit for months. Sellers hesitate to cut further. Buyers hesitate to step in. Investors quietly exit, absorbing losses rather than compounding risk. Condos that once symbolized financial arrival now function as negative carry assets, empty, illiquid, and expensive to hold. San Francisco was supposed to be the market that never broke. So what happens when the city that anchored California's housing narrative loses its gravitational pull? 2. San Bernardino. San Bernardino was never marketed as glamorous. Its appeal was simpler: affordability within Southern California, steady blue-collar employment, and the promise of gradual improvement. For a time, that narrative held. Then the math stopped working. During the peak of the 2021 frenzy, the city's median home price climbed to roughly $410,000. By 2025, that number has fallen to around $260,000, a decline of nearly 37%. In several neighborhoods once labeled revitalizing, values have been cut by more than half. Price reductions are no longer strategic. They are desperate. But falling prices alone do not explain the stress building here. San Bernardino entered this downturn already weakened. It consistently ranks among the poorest cities in California. Job growth lagged long before rates rose. When inflation accelerated and layoffs spread inland, households had little margin to absorb higher mortgage payments, insurance costs, and utilities. Crime compounded the pressure. Property crime rose as financial strain increased, eroding buyer confidence further. Schools underperformed. Public services thinned. Even routine permitting slowed as city departments struggled with staffing shortages. Ownership costs again tell the deeper story. Wildfire risk zones expanded toward residential areas, pushing insurance premiums higher and narrowing coverage options. Property taxes remained fixed near peak valuations. For homeowners already stretched, declining prices offered no relief, only shrinking exit options. There is also historical weight here. San Bernardino filed for bankruptcy in 2012, the largest municipal bankruptcy in California at the time. As prices fall and revenues tighten, residents quietly ask whether the city is approaching familiar territory. Homes are cheaper now, but fewer people can afford the uncertainty. So when a city with limited economic buffers enters a housing downturn, how much damage occurs before prices finally stabilize? 3. Stockton. Stockton has seen this movie before, and that memory is shaping how this downturn is unfolding. In 2021, pandemic-era demand and Bay Area spillover pushed Stockton's median home price to roughly $450,000. By 2025, that figure has slipped to around $290,000, a decline of more than 35%. In several lower-income neighborhoods, prices have fallen well over 50% from their peak. But Stockton's real distinction is not the speed of decline. It is the return of foreclosure pressure. Delinquencies have risen sharply as adjustable rate resets, higher insurance bills, and stagnant wages collide. Foreclosure filings are climbing year over year, particularly in neighborhoods that absorbed heavy investor activity during the boom. Many of those homes were purchased with thin margins, optimistic rent assumptions, and little tolerance for disruption. Insurance has intensified the strain. After updated flood zone mappings, thousands of properties were reclassified as higher risk. Flood insurance premiums surged, often adding thousands of dollars per year to ownership costs. For homeowners already underwater, this pushed monthly expenses beyond sustainability. The visual impact is unmistakable. Partially renovated homes sit abandoned. Bring all offers. Listings linger for months. Rental properties cycle through price cuts as tenants disappear or double up elsewhere. In some cases, owners quietly hand keys back to lenders, choosing credit damage over financial suffocation. Stockton's history matters here. The city filed for bankruptcy in 2012, becoming the largest U.S. city to do so at the time. That precedent hangs over today's market. Residents recognize the early warning signs: rising vacancies, stalled development, and municipal strain. This is not a sudden collapse. It is a slow, grinding unwind driven by fragile ownership economics. When foreclosure pressure returns to a market that never fully recovered from the last cycle, how much resilience is left this time? 4. Oxnard. For years, Oxnard sold a carefully polished promise: coastal air, proximity to Los Angeles, ocean views without Malibu prices. It was marketed as Southern California's balanced alternative, luxury without excess. That illusion is breaking. In 2022, Oxnard's median home price hovered near $830,000. By 2025, it has fallen to roughly $540,000, a decline of about 35%. Along the coast, the correction is sharper. Waterfront condos that once traded above $1.2 million now struggle to clear $700,000, often after months on the market and multiple concessions. But the real damage is not in the listing price. It is in the cost of keeping the property. Insurance has become the defining pressure point. Coastal exposure, wind risk, and wildfire proximity have driven major insurers out of the area. Many homeowners are now forced into last resort coverage plans, where annual premiums exceed $6,000 and deductibles remain punishing. For some owners, insurance alone rivals a second mortgage payment. Property taxes add another layer. Assessments set during the 2021-2022 surge have not meaningfully adjusted downward. Homeowners watch their equity fall while tax bills remain anchored to peak valuations. The math feels inverted: less value, same obligation. Tourism and remote work once softened these costs. That support has faded. Short-term rental demand weakened. Higher-end buyers pulled back. Local residents, already stretched, face rising utility costs and infrastructure strain tied to drought management. The result is hesitation. Listings linger. Sellers sweeten deals with credits, furniture, and rate buydowns. Buyers hesitate, knowing that a lower price does not guarantee long-term affordability. Oxnard still has the ocean. What it no longer has is the financial stability that once justified paying for the view. When even coastal California begins to feel like a liability, where does perceived safety in real estate actually exist? 5. Riverside. Riverside was built on a simple promise. If Los Angeles became unaffordable, the Inland Empire would absorb the overflow. More space, lower prices, a manageable commute. For years, that logic worked. Then the conditions that supported it disappeared. At the height of the 2021 surge, Riverside's median home price approached $570,000. By mid-2025, it has fallen to roughly $410,000, with many neighborhoods seeing declines of 30 to 50%. Listings now sit longer. Price cuts are no longer cosmetic. They are structural. Riverside's vulnerability lies in its economic base. Warehousing, logistics, and distribution, once reliable job engines, have slowed as automation expands and e-commerce growth cools. When employment softens in a commuter-dependent market, housing demand weakens quickly. Ownership costs deepen the strain. HOA fees have climbed steadily as insurance and maintenance costs rise. Property taxes remain fixed near peak-era assessments. Water bills surged under drought restrictions, turning utilities into a meaningful monthly burden rather than a background expense. For many households, total carrying costs increased even as home values fell. The investor exit is visible. Homes once purchased to flip or rent now sit half-renovated, frozen mid-project as financing tightened and resale margins vanished. Rental listings compete aggressively on price, yet vacancies persist, an indication that demand is not merely paused but absent. Riverside's problem is not collapse, it is erosion. The city depends on affordability relative to Los Angeles. When that affordability no longer offsets commuting costs, job uncertainty, and rising ownership expenses, the value proposition breaks down quietly, but decisively. If a market built on spillover demand loses the city it depends on, how long can it sustain itself before prices reflect that reality? 6. Palmdale. Palmdale was one of the clearest bets of the remote work era. Developers assumed distance no longer mattered. Buyers were told that long commutes were obsolete. Space, views, and brand new subdivisions would replace proximity. For a brief moment, it worked. In 2021, Palmdale's median home price climbed to roughly $470,000. By 2025, it has fallen to about $295,000, a decline of nearly 37%. On the outskirts, where the newest developments sit, prices have dropped even harder. Homes that sold near $480,000 now list close to $220,000 after repeated cuts. This was not a demand shock, it was a planning failure. From 2020 to 2022, construction accelerated under the assumption that migration would be permanent. Then interest rates surged. Hybrid work replaced full remote. Gas prices climbed. Living 70 miles from job centers stopped making financial sense almost overnight. The consequences are visible. Half-occupied subdivisions. Rows of identical homes with lockboxes hanging for months. Rental listings competing with each other at lower and lower prices, yet still sitting vacant. The oversupply problem here is not abstract, it is physical. Costs have not adjusted to match reality. HOA enforcement remains rigid even as water restrictions intensify. Insurance premiums have risen alongside wildfire exposure. Infrastructure has struggled to keep pace with expansion, forcing local government to seek outside funding while maintenance falls behind. So, Palmdale now feels suspended between intention and outcome. Too far to benefit from urban recovery. Too expensive to justify as a compromise. What was sold as freedom has become isolation. When a market is built on assumptions that collapse faster than the homes themselves, how long does it take before confidence disappears entirely? 7. Vallejo. Vallejo was marketed as a shortcut. A waterfront city with ferry access to San Francisco. Bay Area proximity without Bay Area prices. For buyers priced out of Oakland and San Jose, it looked like a rare loophole. That loophole has closed. In 2021, Vallejo's median home price hovered around $550,000. By 2025, it has fallen to roughly $330,000, a decline of about 40%. In several neighborhoods, prices have dropped closer to 60% from their peak. Listings cycle through reductions, return to market, and sit untouched for months. The problem was never just pricing, it was fragility. Vallejo's local finances have long been strained. The city has declared bankruptcy twice in recent history, and public services reflect that reality. Infrastructure maintenance lags. Emergency response times stretch. These issues were tolerable during appreciation. They become deal breakers during decline. Insurance accelerated the unraveling. As wildfire risk models expanded and insurers retreated, coverage became scarce and expensive. Homeowners faced rising premiums or limited options at the exact moment their equity began to disappear. For many, the cost of staying exceeded the cost of leaving. The emotional toll is visible in behavior. Longtime residents walk away. Some hand properties back to lenders rather than continue paying into a depreciating asset with rising fixed costs. Rental demand softened as remote workers chose cheaper states with fewer ownership risks. Vallejo was supposed to be the affordable edge of the Bay Area. Instead, it has become a case study in what happens when proximity is mistaken for stability. If the last refugee for reasonable Bay Area pricing cannot hold demand, what does that say about the foundation beneath the region's housing narrative? When cheaper homes still cost more. Taken individually, none of these 7 cities overturn the idea that housing markets move in cycles. Prices rise, prices fall. That part is familiar. What is different this time is what did not fall with them. Across San Francisco, San Bernardino, Stockton, Oxnard, Riverside, Palmdale, and Vallejo, the same pattern repeats. Prices retreated, but ownership costs stayed elevated. Insurance premiums climbed, taxes remained anchored to peak valuations. HOA fees increased. Utilities rose as infrastructure and climate pressures intensified. In many cases, the monthly burden grew heavier precisely when home values declined. This inversion breaks the traditional recovery logic. Lower prices no longer restore confidence. They raise questions. Buyers hesitate because affordability is unstable. Sellers hesitate because losses feel locked in. Investors exit because negative cash flow compounds risk. What remains is not a healthy correction, but a standoff, one defined by uncertainty rather than opportunity. The deeper lesson is structural. Overbuilding met temporary migration. Speculation replaced income growth. Belief in permanent demand overpowered basic math. When those assumptions failed, markets did not collapse all at once. They weakened unevenly, city by city, exposing which foundations were strongest and which were never solid to begin with. This does not mean prices will fall forever, but it does mean the old rules cannot be trusted blindly. So the real question is not whether these cities will recover. It is whether buyers, sellers, and policymakers will recognize that affordability is no longer just about price. It is about resilience. And as this cycle continues to unfold, like the video, subscribe to the channel, and turn on notifications so you do not miss what comes next. Because the next warning signs rarely announce themselves loudly. They appear quietly, inside the numbers people choose to ignore.